Alright, so this is day 8 of my stock market portfolio. So of course my equity dropped big time since the market is sort of crashing. So if we look at my equity in my margin account at the bottom here on the bottom right side, you can see that my equity is 3,400. I mean, it was at 10,000 maybe 3 weeks ago, and now it's at 3,400. So this is definitely because I'm borrowing a lot of money from my margin account. So any slight changes has a major impact, whether it's up or down. That's why if you look at my when I make my videos on my year-to-date returns every month, you'll see that my margin account has a 50% return because I'm making profits on money that's not mine, and then the profits get deposited in my account, goes over my equity, which explains why if I'm doing well with a margin account, then my year-to-date return is going to be very high. And the opposite is true. If I'm doing bad in my margin account, it can drop from 10,000 to 3,000 in a week. All right, so I've got about 3,400 in my margin account and then 39,000 in my TFSA, which was at like 42 or 43,000 this week. And my RSP account is 16,840, so it's pretty sad. Here, let's total it up. So wow, I broke the 50s. I'm at 59,000 now. I was at like 68,000 last video. Now I'm at 59,000. So almost $10,000 lost in a few days. How sad is that? Now let's go see what's causing this drop. All right, so let's start with my margin account. So I've got American Airlines here. So yeah, as you can see, I bought it at, you know what? Let's change the viewing. Let's put it per position, and then let's put per open P&L. Let's sort it per open P&L. All right, so I've got United States Steel. I'm down $3,000 US on. So that's my biggest loss in my margin account. I've got Kraft Heinz that I'm down $2,000. I've got this Netflix position. It's actually a part of an iron condor. So I'm down $2,000, but this is actually, it's not fair to just look at it alone because the call side is probably up maybe $1,500. Netflix, anyways, the loss is capped to $500. So I'm not going to talk about the iron condor right now. I've got NVIDIA. So this one here shows NVIDIA. This line here shows that there's a loss of $1,600, but NVIDIA is trading after hours at about 156, 157 because it went up after earnings. So this one should be fixed. I'm going to end up most likely rolling over my call option on NVIDIA. So as you can see here, I've got a call option expiring tomorrow at a 155 strike, but it looks like NVIDIA will be trading above 155 tomorrow. You can see it's trading at 157 right now. So this call option, I'm going to end up buying it back and then selling the same strike price, but for September 20th. I'm probably going to go 1 week out because I'll get a higher return if I sell weekly options. So I'll probably go 1 week out. So simply by clicking create order, I'll remove the shares. I'll keep the options. I'm going to buy back the call option. I'm going to add another call option, click sell. I'm going to go 1 week out, and then I'm going to choose the same strike price of 155. And as you can see, I'd collect about $1.10 on a 155 strike. What does that give us as a return? So a 0.7% return per week. So times 52 weeks, that's 36% per year. So it's not bad. If I go to September 20th, keep the same strike at 155, I'd collect about $360. But September 20th would be 1, 2, 3, 4, 5. Would be 5 weeks out. Let's see what that gives me. Let's say 360 divided by 15.5. So that gives me a return of 2.3%, which is divided by, we said 5 weeks out times 52. So you can see it's 24%. Yeah, so I'd be getting less return if I sell the monthly options versus selling the weeklies. But of course, if I sell the monthlies, I collect a higher premium upfront, but I'd rather sell the weeklies. Six Flags is trading at 55, so it's trading above my strike finally. It's been a long time since I bought it. It dropped. It's always been trading below 50. So now it's finally trading above 55. It's the only one that's going up when all the other stocks are going down. Makes no sense. All right, so I'll probably close out the trade. I don't think I'm going to sell another call option. Actually, let's go see what happens if I want to sell another call option. So same thing. I'll click create order. I'll remove the shares from the order. I'll add another call option. I'm going to click sell, choose September, keep the same strike, 55. So I'd probably collect $1.15. Yeah, let's say $1.15 on a 54 price. because I bought the stock at 54. So $1.15 divided by 54 gives me 2.1% in 5 weeks times 52 is about 22% per year. Yeah, I don't think I'm going to roll over this call option. I think I'll just take my money back. Plus, I bought the stock at 54 and I'm going to sell it at 55. So I'm also going to make an extra $1 just by letting my shares get called away at 55. And every month I was selling call options while I was holding this position. So yeah, I'd rather get my money back. I'm sure there's better opportunities right now. There's so many stocks that are down. I'd rather buy like Activision or EA, Electronic Arts, than to keep my money in Six Flags. So most likely I'm going to get out of Six Flags tomorrow. Nvidia I'm going to keep. And all my other options that are expiring August 16, well, they're all below the strike. I mean, look at Box. My strike is 20. It's trading at 13. So I'm going to end up keeping it. I'll try to sell another call option against it. But most likely I'm going to wait a bit because the premiums are going to be so low if I stick to the same strike price. So I'm going to have to wait for the market to come back up again, which I think it will. It's either going to crash or come back up. These are not the regular trading prices of these stocks. So it's either going to continue dropping or it's going to come back up. So I'm just going to wait for the stocks to come back up before I sell another call option against them, just to make sure I get a higher premium. So basically a lot of them are expiring tomorrow. I just need to wait so I can sell higher premiums. And then SNC, same thing. I've got some iron condors. Where's Netflix? Yeah, there we go. So Netflix is causing me a lot of trouble. As you can see here, I'm down. This has a 310 strike. So I need Netflix to be above 310 by tomorrow. That's not going to happen. And I have another iron condor position or credit spread. If you watched my video yesterday, I talk about credit spreads. So this one, I need Netflix to be above 320 to make my full profit, but it's not. It's trading at 296. So what I'm gonna end up doing is most likely I'm gonna try to roll it over to September 20th. So I'm gonna give myself an extension of 5 weeks for hopefully Netflix to trade above 320, so I can avoid losing max loss on these trades. And I do think it has a good chance of trading above 320. And to roll over, basically I'll just click create order on one of the vertical spreads. It'll open the order entry. So automatically it generates the order entry to close the trade. But I'm going to customize it. I'm going to add 2 more puts because I want to roll it over. I'm going to go to September 20th, which is the next monthly cycle. I'm going to sell. I'm going to take the same strikes. I'm going to sell the 310 strikes. I'm going to buy the 305. So the option that I'm buying is for protection to limit my max loss. All right, so I'm selling the 310, buying the 305, and this one here, for August 16, I'm buying the 310 because I'm basically closing the trade out. I'm going to close this section here for a loss, and this one will be for a credit. Hopefully, this credit compensates for the debit that I'm going to have to pay for this one, but based on what we see here, it looks like it's not going to compensate. It looks like it's going to cost me money, probably like around $150 just to roll it over to next month. But I don't want to do that. What I could do is probably sell 2 contracts. So if I sell 2 contracts, then I could do it for a credit. But it's kind of risky because then I'd be increasing my risk. What if come September 20th, Netflix is trading below 310? Well, then instead of just having 1 credit spread that's causing me trouble, I have 2 of them. But because I feel like Netflix usually trades in the 300s and this isn't its regular price, it's just because of the general market correction. When the market rebounds, I think Netflix is also going to rebound because just 2 weeks ago it was trading above 320, even after earnings. Even after it took a huge drop after earnings, it was still trading above 320. So that's probably what I'm going to end up doing with Netflix tomorrow. The SPY, I mean, they still have a while before they expire. Same thing for Tesla. But as you can see, I think I'm down. Yeah, I'm slightly down. So it's about $60 profit on the call side, but about $40. So I'm up $20, but I'm not going to close it. I'll wait it out. Weight Watchers doesn't want to drop. I want it to drop below 25, but look, it's stuck at 29. Even with what's going on in the market, it doesn't want to drop. It's being stubborn. Let's see if the SPY I placed yesterday, the credit spread that I placed yesterday on the SPY, expiring September 13 at a 275 strike, collected $95. Yeah, so it's actually, I would break even. If I close it early, I'd make zero profit. I'd be wasting $16 in commissions though. Or sorry, $12 in commissions. Now if we look at my TFSA, let's put it under position and sort it by P&L. So Teva Pharmaceutical is the biggest loser for me, 3,200. Chesapeake Energy, Grubhub today took a major drop. I'm down 1,600 because of Grubhub. Bed Bath & Beyond. I don't even know why I bought Bed Bath & Beyond. Probably because the premiums were high and the stock took a drop. But it's but it's dropping even more. Got Macy's, Neo, Afria, Freeport, McMoran, Halliburton. If we go look at my RSP, same thing. Let's see what's Novavax, of course. I'm down $5,000. Yeti Holdings, it's not so bad though. Like Yeti, I know it's because of the market. Square, it's because of the market. L Brands, it was trading at 26, so I would say L Brands is because of the markets. Bombardier, same thing. So RSP, I'm not too worried. Novavax is the only bad one. In the TFSA, I mean, Teva, I have no idea what's going on. It was trading at $18 when I bought it, and now it's at $6. Chesapeake Energy, I think it has a good chance of coming back up. Grubhub, I also think it will come back up. Really, what I'm worried about is IMGN, Macy's. I mean, retail's not doing well these days, so Macy's might take a while to come back up. Bed Bath & Beyond as well. Afria, who knows? Halliburton, I think, is going to come back up as well. I've got Unit here that's going to be a profitable trade for the month of August. I'm going to end up closing for probably at around 7.5. So I think it gives me 5% return in 1 month with this trade here. I didn't put much money though. See, right now it's showing a profit of $40, but it's going to be more than that tomorrow. So all these covered calls that are going to expire worthless. Uber, for example, my strike was 40. The stock is trading at 33. So my call option is going to expire worthless. Let's say I wanted to sell another call option right now on Uber for the following month. So I'll remove the shares, I'll add another call, click sell, go to September 20th. But of course, choose a 40 strike. I'd be collecting $25. I mean, it's something, right? If we're looking at dividends, it's decent, $25 on a $4,000 price or investment. $25 divided by 4,000 invested. That's 0.6 per month times 12. That's 7.5%. So if I'm seeing it as a dividend, then of course 7.5% is great. But I don't see it as a dividend. I'm trying to see it as an income per month. And since this is on margin as well, so I'm paying interest on this, and I'm paying about 9% per year. So for me to make 7% per year is not enough. I'd be actually losing money. So I have a few choices. Either I just wait for the market to rebound, or I can buy more Uber, but I don't want to do that. Or let's say I go 1 week out. That's not enough. I could go for a shorter period just to collect something, and also at the same time give Uber a chance to come back up. Or what I could do is sell at a lower strike price. Right now the stock is trading at 33. I could sell at 36. But then of course I have the risk that if by September 20th the stock is trading above 36, I have to sell my shares at 36, but I bought the stock at 40. So I'd be losing $4 by selling my shares at 36 just to make a higher premium of at this strike of 36, I'd make about $95. $95 divided by my cost of 4,000 is 2.3%. So yeah, this is a return that I want, but I don't want to take the risk of choosing a lower strike, because if it does end up above 36 come expiry date, then I'm gonna have to buy back the call option at a loss and then sell another one either at the same strike or whatever I paid to buy back the call option. I'm gonna have to add it to my cost basis. So instead of my cost basis being 40, if I had to pay $2 to buy back the call option that I sold at 36, then my new cost basis will be 42 instead of 40. So I could see it that way as well. I could take the risk of choosing a lower strike price to get a higher premium. And if it does end up above my strike price, then I'll just have to buy it back and increase my cost basis. But I don't want that headache. Let's do 38. Let's see if I do 38. I guess I could do 38, collect $50. But do I think that between now and September 20th, do I think that Uber can go from 33 to 38? I think it can, because it dropped from 40 to 33 in a week. So I think that in 4 or 5 weeks, it can go from 33 to 40, especially to fix what it just did, just because of general market correction. So yeah, I think my overall best strategy right now, instead of selling call options for the next month, is maybe wait a week or two max, and then decide if I want to sell call options at a lower strike price or go further out. But while I'm waiting, what's great with the strategy that I was talking about yesterday is I could sell another credit spread either on the SPY or on Facebook. And if you look at Facebook, it's trading at 183. Let's say I say that for the next 30 days, I think Facebook is going to trade above 165. I don't think it's going to drop below 165. So without having to buy the shares, without having to buy the stock, I just go sell a credit spread. So it's called a vertical, and I go 30 days out. Let's say I'll go to September 20th. So 36 days out, sell a credit spread at 165. So I'm going to sell the 165 put option, and I'm going to buy the 160 put option for protection. So my max loss is the difference between the strikes. So 165 minus 160, so it's $500. But I'll collect about $62 to make this trade. So my max loss is actually $500 minus $62. That's my max loss. My max profit would be $62. I keep that $62 if Facebook does stay above 65 come September 20th. And according to the probabilities, there's a 12% chance that Facebook does stay above 165 come September 20th. So this is the type of trade I was talking about, without having to buy Facebook, without caring where Facebook is right now. Is it a good price to buy in or not? I just have to pick a range, and the range I'm picking can be based on probabilities. I could go with 5%, 10%, or 15% to be safe. So usually when a quality stock drops hard, especially because of the just general market correction, it doesn't continue to drop. Usually there's a mean reversion that occurs. So the stock usually comes back up to where it was normally trading at. So because of that, when a stock drops hard, it's a good time to sell a vertical put or a put credit spread. And here in this example, I'm picking 160, but I could pick 170, for example, 170 and then 165. I make my profit as long as Facebook stays above 170 come September 20th. Facebook was trading at 200 after its earnings. So I know that 183 is not its normal trading price. This is because of the market, general market conditions. It's not something related to Facebook directly. So if I pick 170 as a strike, that Facebook will not go below come September 20th, I would collect about almost $90, risking $410, and that would have a probability of 20%. So there's a 20% chance that Facebook trades below 170. So that means there's an 80% chance that I win in this trade. So if we play the probabilities, I've got an 80% chance of making, let's say, $90, but then I've got a 20% chance of losing $410. So you see, if the more I place these trades, I would actually be losing money, because as you can see, I would have an 80% chance of making $90, so that's $72, minus a 20% chance of losing $410, so that's $82. So I'd actually be losing $10 the more I place these trades. But because these trades are meant to be managed early, I don't necessarily have to wait till expiry date. As soon as I have a chance to close the trade early before expiry date, I collected $90, but I can probably buy it back for $50 or $40 to close the trade early. As long as Facebook starts moving, there's two ways I can close a trade early for a profit. If the stock starts to move away from my strike of 170, or if the stock stays put as is, but time goes by. So these two factors will make my premiums, will make my trade profitable, and I can close it earlier for a profit. All right, so this was just a quick overview of my portfolio today, and as you could see, I'm really affected by these market conditions because I own stock. So if you have any questions, any comments, any suggestions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back from Questrade. Also check out the other referral links below. Thanks for watching.